Hey, welcome to the Exchange. Let's talk about Stryker International, and the short seller report just came out on it and what's going to happen potentially in the next few months. So this is a Stryker chart I pulled up right here, and this chart's really interesting because it's almost glued to that 260 mark. I mean, it's been up and down with volatility, post Omicron variant, also the Ukraine war, but really it's been sticking around that 260 mark almost like glue, which is kind of surprising for a kind of a high growth company that like you think Stryker would be. The past 5 years, obviously, initial COVID, basically recession dip, but I mean, it's been on a steady incline, but really the past 5, 6 months, it's almost been flat. It's almost been like a defensive name in the entire sector, which is actually kind of surprising. I thought it'd be a lot more volatile than it actually is. Look at the chart. So this is the actual short sell report for Stryker. This is from Spruce Point Management. They're a short selling firm, so they basically focus actually on stocks that either are frauds or potentially mismanagement, where they think, hey, it's overvalued at the current point, it's going to drop in the near future. But here's some high-level bullet points. We'll dive into some of those later. Go to the very bottom. You guys download the report yourself. Actually, I'll drop this link in the description below. That way you guys can look on your own time. But let's dive into the actual report itself and see what we can find there. So this is the actual report right here. As you can see, it's 200 slides. I mean, this is very, very in-depth. And really, the reason it's so long, because Stryker is a very complex business, so you have to go into all the various business segments, which is why it's so long. But I mean, I really short sellers in the future would actually have almost like a TikTok, almost like a Twitter version, where it's like, hey, here's a so what analysis. Because like for your average investor, they're not going to read this. Only people are going to read this will be like Spruce Point executives themselves, and probably the Stryker legal team themselves will actually read this in depth. But I mean, this is almost way too long for most short seller reports. But normally they're like 40, 50 slides at most. This is a very complex one, so it's like 200 slides, which again, you don't need to know every single slide, though. The overall theme itself, you can fill pretty fast, even just a few slides of research. So first things first, actually look at their past history of Spruce Point. They actually have a pretty good track record for medical device companies or medical companies. So like TOS and HSKA, they actually were two short reports they did back in 2017 and 2021. So I mean, they actually had pretty strong results there. So I mean, they have a good track record for medical device companies. So we'll see if Stryker is. I mean, Stryker is a much bigger company overall, but we'll see if they actually are right about Stryker too in the next few months and or a year plus. So slide 7, this is the big kind of so what slide. And really what they're saying is 35% to 75% downside risk for Stryker right now. So they're saying from $67 a share up to $174 a share. And really what they're saying here is post-2009 financial crisis, basically great financial crisis we had, basically Stryker embarked on an aggressive levered roll-up strategy, which basically means they took debt out and they basically took this debt to acquire new companies, which again, those companies are high-quality companies. It's absolutely fine. It's a good way to grow inorganically. But again, what they were saying they're buying is basically crap companies or companies that are high risk, or some of these returns are just not worth the actual debt they're taking out. So right now, they're a pretty levered up company overall. Some of these bills are starting to come due, where it's getting a little painful. But basically what they did is they diverted 60% of their cumulative capital raises towards acquisitions, which again is fine, but it's a large overall M&A portfolio book. They're actually built in the last 10 years plus. Really what happens is they amass $16 million of debt right there, also $18 billion of goodwill and intangibles, which basically like the goodwill and intangibles basically. So you have a book value of an asset where it's $1 billion. The goodwill is the actual acquisition price over that value. So let's say you acquire a company for, let's say they're worth $1 billion. You acquire them for $1.2 billion. You have $200 billion of goodwill right there. It's basically a premium you pay over the book value or net asset value of that acquisition, which again is totally fine if the acquisition is high quality and it grows with the company. The problem is if that acquisition drops, and let's say it's not worth that much, also you do an impairment charge on your accounting books, and all of a sudden you have basically a liability to goodwill or an impairment to goodwill, which could drop your actual assets down pretty fast. One more thing I want to notice here too that I would point out is basically Stryker sales are about 50% elective surgeries. So you think, hey, Stryker, a medical device company, necessities, absolute necessities, but it's about 50% elective surgeries or elective basically implants or elective procedures you're going to actually have done, which again, that's totally fine though too. But you think about the economy we're in right now, potential recessionary environment, potential low cash flow on a household basis. I mean, this could be a problem for them in the near future potentially if these elective surgeries all of a sudden drop off a cliff and they are no longer as viable for most families. So this is a very, very important slide. Basically a roll-up of their M&A activity, so mergers and acquisition activity over the last 4 years. So basically what it's saying is total acquisitions, net cash acquired, basically net of cash acquired. They acquired basically $2.4 billion in 2018, $339 billion in 2021. So total value of all its acquisitions, $7.8 billion. Acquisition integration costs are $829 million. But what the problem is right here, what it's saying is, hey, the revenue from acquisitions, this is like new revenue from these acquired companies. They're saying, hey, 2021, it's only $789 million that year. And that's on the actual 10K itself. The actual proxy statement, which you get to shareholders for your annual meetings, I mean, look at this, -$3 million, -$7 million, $21 million, $1 million. I mean, total value they actually gained in actual revenue, they're saying, is $12 million, where they spent $7.8 billion. So, I mean, the orders of magnitude there are just totally different. And here's the problem right here, basically, it's the whole idea of like low quality acquisitions. the problem right here is, I mean, as these will ramp up, these will get bigger and bigger on the bottom line, but this, I mean, the price you're paying to cover basically break even rate right there is going to take years or decades potentially for some of these acquisitions to actually break even and or produce a positive profit, which look like return on investment or like a stock return on investment. I mean, this is going to take forever potentially. It's almost like value dilutive for the actual current shareholders of Stryker itself. So this is another very important chart. This is really the idea of a capital stack. So really the idea of a capital stack is if the company were dissolved tomorrow, who would get paid in what order? So first you get paid your creditors always first. So your debt holders, accounts payable, receivable, basically account payables to like suppliers, etc. They get paid first. Money left over goes to your equity holders. So preferred equity holders first, and then finally your common stock holders themselves. So equity holders are more risky because like they're down lower in that tranche, lower in that stack to get paid if the company defaults or something happens. And this is for any company, not just Stryker. So basically what it's saying here is, hey, if you're a bond holder or a debt holder, it's less risky to hold that debt versus holding the equity. What's surprising here on the right-hand side, as you can see, is the unsecured debt holders, this is like your top of that stack, are actually dropping in price. So basically they're assuming more and more risk overall according to the debt markets. This is for 2046 U.S. unsecured debt notes. Also, June 2030 unsecured debt notes, you're seeing them drop as well too. So, which is surprising because typically, if you see the debt values drop, you see the equity values drop too. And that's what Spruce Point is pointing out here. It's a little bit weird because it's like it's counterintuitive. So the riskier asset is actually stable in price, while the less risky asset is actually dropping in price. So what they're saying is, hey, maybe this equity asset is being propped up artificially, and it might drop in price in the near future because the bond prices are actually dropping ahead of it potentially, which is kind of surprising overall. So generally in accounting, keeping two sets of books is really a red flag. It's a bad thing, like a la Enron or any of the other potential frauds out there. But really with number 4 down here, this is like top 5 questions for management, is depreciation and amortization tables that keep two sets of books themselves. So basically the idea there is for the book for the cash flow statement, it's separate from the book from the actual business segment themselves, which is surprising, which is kind of odd though too. And it could be a ways to recognize income or defer taxes, etc. But that is very surprising, and it's very like almost like a red alert, basically saying, hey, they're basically playing accounting games behind the scenes, trying to make sure their net income is overall higher than probably should be according to the actual true GAAP basis. So this really shows us basically their cash flows, basically uses of and sources of cash itself. So you look at operating cash flow here. I mean, this is 2013 and 2021. I mean, you see strong growth in the 2010s decade overall, but really, I mean, since 2019, 2020, 2021, it's been pretty flat and pretty stagnant. You think, hey, all those acquisitions, all that growth, it'd be strong revenue growth on the top side, but I mean, as we've seen, it just hasn't materialized yet. We're not just quite seeing that. And also, you see like net debt raise. I mean, they've been raising debt for the past decade plus. But look at 2021; they're actually paying back debt. They're actually trying to delever themselves potentially, which is going to hurt future growth too. But you can't grow as fast there. Also, look at stock repurchases. This is almost like they're basically buying their own stock to basically retire it. It's basically stopped, which is, I mean, this is surprising how fast it stopped. And it's showing, hey, they're almost like a distressed financial company where, hey, maybe they're having cash issues behind the scenes. Also, look at acquisitions. I mean, it's been growing steadily over the 2010s. But then look at the last year. I mean, it's been drop off a cliff. And this, again, goes to that kind of the idea of, hey, maybe they're having cash issues behind the scenes. Maybe they're trying to conserve cash. Maybe they're having some bad assets they're trying to spin off or spin in the holding companies there. This isn't saying much. All it's saying, though, is potentially there's behind the scenes, there might be some cash issues that they're having to deal with internally, which could potentially rear its ugly head later this year or even next year. So next is this idea of GAAP versus non-GAAP. If you don't know what GAAP is, GAAP stands for Generally Accepted Accounting Principles. It's almost like the accounting rule book in a way, but off that we also have basically non-GAAP principles. And it's basically companies can work their accounting to basically match their industry, match their overall business objectives, etc. But I mean, you do want to see a strong GAAP presence there, but it's almost like a baseline. Hey, according to GAAP, here's what we actually reporting. Here's what we actually have. That way, everyone plays by the same rules across industries, across various companies, etc. But what this graph is showing here from 2017 and 2021, this bottom line right here is showing, hey, there's more and more adjustments away from GAAP. Like they're not playing, or they're playing by the rules, but they're kind of pulling away from the rules overall. Which again, this is fine. It's not saying anything good or bad. It's just saying, hey, there's more potential risk for discrepancies, more potential risk for impairments, either up or down, potentially for some of their assets, etc. It's been on the watch. I mean, this might go potentially much, much higher in this decade, potentially for Stryker, if they don't change some of their operating principles overall. So this is a real red flag, and this is something we don't know, but going to kind of the cash distress story. I mean, they actually failed to pay the property tax, or had delayed paying their property taxes last year. And this is something there's actually a quote from almost a year ago from the CEO. So in addition to the discretionary spending controls, as I previously outlined, we've also taken steps to conserve cash, including reductions in planned capital expenditures and project spending, focusing on opportunities in accounts payable and slowing M&A activities. So like I said earlier, I mean, the M&A activities, the size they are right now, to have new, basically value accretive deals, and they have to be absolutely massive. We're talking billions of dollars overall. Also, too, looking at the overall way their capex spending's dropped off a cliff, other issues they're having. I mean, this might be a company that potentially behind the scenes is a good company, but maybe internally the cash they're burning is just not sustainable at the debt levels they're at right now. So this is another point here, and this is something games play, people with accounting, basically stretching a depreciation cycle there. So as you see, 2019, they had a 10-year depreciation cycle, and then now they're basically going from 3 to 15 years. So basically making that the D&A cycle much longer, which I'll give you an example of how that really affects you overall, but we'll dive into that right now. So it's an example of buying a car. Let's say, hey, we buy a $30,000 car. Let's do scenario one. Hey, buy a $30,000 car, useful life of 10 years, $2,000 per year of depreciation. Pretty simple scenario, but it's a straight line depreciation. So, hey, after year one depreciates by $2,000, your car's actual trade-in or basically residual value is $28,000. By year 10, you're saying, hey, no, $2,000 is taken off. And by year 10, you're saying, hey, if you trade in your car, sold it, it's worth $10,000. That's scenario one. Scenario two, same scenario, but let's do a 15-year useful life here. Let's do $1,333 a year of depreciation. So same scenario, you basically every year lose that depreciation value, and you have the remaining basically trade-in or selling value. But look at year 10 though. So year 10 in scenario one is worth $10,000 if you sold it right there. In scenario two at year 10, it's worth $16,670. That's a massive difference. Which again, the scenario two might be more accurate, and maybe it is a 15-year depreciation cycle. The problem is if it's scenario one though too, you're gonna potentially have issues because let's say, hey, year 10 you sell the car, you have to sell the car because things are changing, you have issues potentially behind the scenes. So scenario one, there's no impairment. The value is $10,000. You had it on the book value of $10,000. Scenario two, you might have an impairment of $6,670. So if you're forced to sell potentially earlier than the life itself, if you don't actually track depreciation that closely, all of a sudden you have basically an asset on the books for much more value than it actually should be. And which this is fine if it's like a one-off scenario or one-off basic capex expense. But if this is happening year over year over year, I mean, you could have major issues for the long term, which could be billions of dollars of basically overinflated assets on your books. So it's another great slide from the last 4 years or so, but really you see in the past 2 years. I mean, they stalled for cash flow. It's really his flat line. The actual growth you thought you'd see with its heavy M&A activity would actually grow them. It's had not appeared. It's not actually transpired overall. So now the problem is they have basically stagnant cash flows with heavy debt loads, and that's why potentially the stock might be in a downturn. And you've already seen that in the debt markets already. So this is a funny slide, I think. It really shows kind of how they've changed. So this is basically from 2017. They stopped reporting returns on invested capital. So basically their M&A activity, how much they're actually generating gains that are accretive to the actual shareholders themselves, which is kind of weird though too. But this is from 2016. It's from a CEO, basically saying, hey, we won't just pay whatever to companies. We're very disciplined with our M&A activity, which that's the way it should be. You should pay, hey, fair market value, not overpay drastically. But this is from literally Spruce Point, basically former Stryker M&A professional there. So basically someone who worked in the M&A teams with Stryker. And it says basically Stryker name carries a premium to it. We believe we overpay. When I was there, I felt like we overpaid for deals. One of the challenges I find with the M&A teams and with Stryker is this psychological effect. They get very entrenched in having specific companies. So basically they get tunnel vision. It's like, hey, I want to acquire company A. And if we can't acquire them, we're going to pay an absolute premium where no one else can compete against us because we want to have company A. Which again, if you know company A is fantastic, that's totally fine. The problem is though, the back-end integration, the back-end revenue drivers and synergies, if it's not there, I mean, it's just basically destroying shareholder value and destroying cash flow with the process. So this is a chart of their merger acquisition activity in the last 6 years or so. Basically, what they're highlighting here is enterprise value divided by last trailing 12 month sales. So basically, revenue over the last 12 months. Again, you started off 2016 timeframe. Hey, they're paying 5 times, 6 times, 8 times here, but now we're looking like 14 times, 23 times, almost 7 times, 13 times. I mean, it's just getting up and up and up, which is fine. If you know the companies are, hey, these are high quality companies, competitive bids, etc., it's absolutely fine. But if the revenue will not match that valuation, all of a sudden you start absorbing that loss as a Stryker shareholder and potentially could roll over potentially, where all of a sudden they have a lot of either bad assets or bad debts, or potentially worse, even asset markdowns, which will hurt the overall equity investors across the board. Hey, that's the end of part one. Go ahead and click over next door for part two and the finale of the Stryker series.